Imagine standing at a financial crossroads. Inflation is still lingering above target, yet households and businesses are suffocating under the weight of high borrowing costs. Do you keep interest rates high to fight stubborn inflation, or do you cut rates to rescue a slowing economy? This is exactly the dilemma facing the Bank of Canada, BOC, today. And according to leading economists like Royce Mendez of Desjardins, the central bank may soon take the bold step of lowering interest rates, even while inflation concerns remain in the background. This potential move marks one of the most crucial turning points for Canada's economy, especially for homeowners, mortgage holders, and anyone thinking about entering the real estate market. Rate cuts could spell relief for some and fresh challenges for others. But why would the BOC risk loosening monetary policy when inflation hasn't fully cooled? Let's break it down. Why rate cuts are back on the table. Canada's economy has slowed significantly in 2025. Unemployment hovers around 7%, the highest in years, and consumer spending is faltering. Businesses are reporting weaker sales, and housing markets, once red hot, are cooling rapidly, particularly in Toronto and Vancouver. For the BOC, this softening economy is flashing red lights. High interest rates, designed to cool inflation, are now dragging growth down more than expected. The danger? If rates stay too high for too long, Canada could tip into a deep recession. Mendez and other economists argue that economic stability must now take priority, even if inflation is not fully back at the 2% target. Inflation, still a concern, but losing momentum. Inflation remains slightly sticky, sitting above the central bank's comfort zone. Food and rent costs continue to climb, frustrating households across the country. But beneath the surface, inflationary momentum is fading. Energy prices are stabilizing. Supply chain pressures have eased compared to the pandemic years, and wage growth, while still elevated, has slowed. The BOC knows that inflation doesn't fall overnight, but if economic weakness persists, inflation could cool naturally without further rate hikes. This explains why some analysts believe the bank has space to cut without reigniting runaway prices. Mortgage holders, the biggest winners and losers? For millions of Canadians, this debate isn't abstract economics. It's personal. Mortgage borrowers are at the heart of the story. Variable rate mortgage holders. They've endured skyrocketing monthly payments as the BOC raised its overnight rate in past years. A rate cut would bring immediate relief, potentially lowering monthly bills and easing financial stress. Fixed-rate mortgage holders, many locked into rates at historic highs. While they won't see instant relief, a trend toward lower bond yields could help when it's time to renew. First-time buyers. Lower rates could open doors to affordability, but they also risk reigniting demand and driving home prices higher again. In short, mortgage markets are caught in a delicate balance, relief on payments, but possible renewed competition in housing. Toronto and Vancouver. Case studies in stress. Nowhere is the mortgage crunch clearer than in Toronto and Vancouver. These markets have seen average home prices fall by $150,000 or more from their pandemic peaks. Rising delinquencies, mortgages in arrears for 90-plus days, are climbing to levels not seen in over a decade. For banks and lenders, this trend is worrisome. While arrears remain relatively low compared to global standards, the upward movement is undeniable. If the BOC cuts rates, it could stabilize these vulnerable markets by giving borrowers more breathing room. Economic signals, forcing the BOC's hand. Several indicators are pushing the central bank toward easing. Job market weakness. A 7% unemployment rate suggests significant slack in the economy. Without relief, job losses could spiral. Falling consumer confidence. Canadians are pulling back on spending, a red flag for growth. Cooling business investment. Companies are delaying or canceling projects due to high borrowing costs. Global context. Other central banks, including the U.S. Federal Reserve and the European Central Bank, are signaling or enacting cuts. The BOC risks leaving Canada uncompetitive if it holds rates too high for too long. Risks of cutting too soon. Of course, the move isn't without risks. Cutting rates prematurely could fuel a rebound in borrowing and spending, reigniting inflationary pressures, particularly in housing. A renewed surge in real estate prices could undermine affordability goals and force the BOC into another round of painful hikes later. Critics argue that the central bank should wait for inflation to firmly return to 2% before taking any action. They warn that once credibility is lost in the fight against inflation, it's incredibly hard to win back. What Canadians should watch for. With the next Bank of Canada rate decision scheduled for September 17, 2025, all eyes are on Governor Tiff Macklem and his team. The following signals will be crucial. Inflation reports. If CPI continues to edge lower, it strengthens the case for cuts. Labor market data. More job losses could pressure the BOC to act. Bond market trends. Falling yields could preemptively lower fixed mortgage rates. Global central bank moves. Canada rarely acts in isolation. International trends will weigh heavily. The bigger picture. Balancing act ahead. The debate around rate cuts is really a debate about balance. Balancing inflation against growth, stability against affordability, and short-term relief against long-term credibility. For Canadian households, this is about more than numbers. It's about whether families can stay in their homes, whether young Canadians can afford to buy, and whether businesses can invest with confidence. The BOC faces an unenviable task. Any decision it makes will ripple through the economy for years to come. So here's the big question. Should the Bank of Canada cut rates now, even if inflation hasn't fully cooled? On one hand, a cut could provide overdue relief to millions of households and help prevent a deeper economic downturn. On the other, it risks reigniting housing market speculation and undermining the fight against inflation. What do you think? If you were in Governor Macklem's seat, would you prioritize easing the pain of high borrowing costs or stay the course until inflation is truly conquered? Drop your thoughts in the comments, because this is not just a story about interest rates. It's about the financial future of every Canadian.